Commercial loans are the last major type of loan that people use to buy rental property. Now, commercial loans go toward a company or corporation. They're business to business. So only an LLC, C Corp, S Corp can get commercial loans. John Smith or Sally cannot get a commercial loan. You have to have an LLC or corporation established. But the interesting thing is that commercial loans are not very regulated. There's no fixed set of criteria like they are for VA loans, FHA loans, or conventional loans, which are regulated by the federal government. Commercial loans are really up to the banks to determine. As long as they meet the bank's internal risk requirements, they can give you commercial loans. And that's why there's no set of conditions. Now, banks underwrite the property. They don't underwrite you specifically. They do a global assessment of the individual, but it's not strict like it is with a conventional loan. They can look at you and they assign a risk to you. And they may say you're too risky, but really what they're looking at is the property. They want the property to make sense. They want the property to cash flow. So they can have some discretion on how to count income, expenses, and your personal expenses that's in income. With business-to-business loans, commercial loans, there's no limit to the number of loans or the value of those loans except for what the bank decides. So the small community bank might have a $2 million lending cap where they say we are only going to lend up to $2 million to any one person or one entity. Other banks might be 10 million, or large banks could be in the hundreds of millions or even billions. So high you're not even worried about it. So unlike conventional loans, which have a 5 or 10 loan limit, there are no limits established by the government for this. And if you do run up to the limit, you can always find a new bank and reset the limit. Now, like I said, there's a lot of different terms and conditions for commercial loans and getting rental property with these commercial loans. Now, sometimes you'll see the loan term and amortization can vary. So, for example, it could be a 5-year loan term with a 25-year amortization. That basically means you're paying monthly as if it was a 25-year loan, but it's actually due in 5 years. It's kind of hard to explain, but basically what happens is after 5 years, the loan is nowhere near paid off, but the entire balance is due, and that's called a balloon payment. So if you have a $100,000 loan and you're paying $500 a month, after 5 years, you've only paid maybe $10,000 or $15,000 off. The other $80,000, $85,000, $90,000 are due at the end of the term. If you don't have that money, then they'll take the property from you. Really, what you're supposed to do is refinance the property after that term is over. And the banks usually make it pretty easy to refinance, but here's the problem. If the economy turns and property values go down, you cannot refinance it and you will go bankrupt. This happened en masse during the financial collapse. I know people who own 30, 40 properties, all under financing terms like this, which was fine when the economy was doing well. But as soon as it turned, the property values dropped and the banks did not want to make the loans. They all came due, and one at a time, those banks took those properties away. And it totally wiped out people in their entire portfolios. So that's why I don't like those terms. Now, what I do like is when the loan term and amortization match. If it's a 20-year loan with a 20-year amort, or a 25-year loan with a 25-year amortization. Reason why I like it is because it matches with my goals. My goal is to have long-term rental property. And there's no risk of the bank taking it away from me if I cannot refinance it. I can always refinance it later, but if I can't get it done, then nothing happens to me. Now, most of them have variable interest rates. The only reason why fixed interest rates exist is because of Fannie Mae. Business to business always has variable interest rates, but I like 5/5 ARMs or 5/1 ARMs the best. It gives you 5 years locked in and then adjusts 1 year or 5 years at a time. Now, you can always sell the property if the interest rates get too high, but it's really not that big of a deal. Now, there's a trade-off between down payment and loan term. Usually, loans with longer terms have higher down payment requirements. So a 25-year loan oftentimes has a 25% down payment requirement, or 30% I've seen also. Shorter terms have lower down payment requirements. Banks assess them as less risky for whatever reason. So a 20-year loan might only have a 20% down payment. The goal is to keep it down payments at 20 to 25% though.